Hey everybody, this is Dan back with another mortgage explainer, and today we're going to be talking about how lenders calculate what we call the debt to income ratio. Now, the debt ratio is a very important thing that lenders have to take a look at. It lets us know how much that somebody can get approved for and if they can qualify. So to put it very simply, the debt ratio is taking your total monthly debt divided by the monthly income, and that's where we get the debt ratio from. I'm going to break down just a little bit more as far as actually what debt that we need to count and that goes into that equation, and also talking about how we calculate the income just a little bit here as well. And it also depends on what loan program that you're going to be using for the purchase or the refinance. On a conventional loan, for example, in a perfect situation where a client has good to great credit, you can go up to a maximum of 50% on the debt ratio. So if the client makes $8,000 per month, and by the way, with the income, we do count the gross income before taxes are taken out. So if somebody does make 8,000 per month, then 50% would be 4,000. So your total monthly debt cannot exceed $4,000. Otherwise, you're going to be over that 50% limit for the debt ratio on a conventional mortgage. Now, there's other programs that have different debt ratio requirements. Some may have a little bit less and a little bit more. For example, FHA, sometimes you can go up to 55 or 56% if everything else is looking great and you have a strong application. And with VA, sometimes you can even exceed that, for a well-qualified veteran. So again, those guidelines do vary depending on which loan program that you're going to be using. But let's talk about what all is included in the debt that we have to count towards that debt to income ratio. So the first one certainly is the housing expense. The home that you're either refinancing or looking to purchase, what is the total monthly housing payment, including principal and interest, which is determined by your loan amount, your interest rate, and your term, if it's a 30-year mortgage or less. But it's not just the principal and interest. We also have to include the monthly cost for your property taxes, homeowners insurance, and if there's any mortgage insurance on the loan as well, those are all included in that housing expense. And then lastly, just depending on your property specifically, if there's any condo dues or association dues, that's also included in that housing expense. So you add up, again, your principal and interest portion of your payment, the taxes, the homeowners insurance, and then any other mortgage insurance association dues or things like that, and that creates your housing expense. Now, in addition to that, the other debt that we have to count in that calculation for the debt ratio are the accounts that are reporting to your credit report. So things like auto payments, credit cards, student loans, things like that. Now we just look at what the minimum payment is because a lot of people will pay a little bit more on different accounts, especially credit cards, than what the minimum amount shows that is owed each month. But as far as for qualifying, we are just focusing on what that minimum amount is that is due on those accounts. Okay. Now there are other things that can factor in that are not on the credit reports, but we don't look at things like utilities, cell phone bills, gas and electric, cable bills. Okay, those things are not included in the debt ratio. And same with food and entertainment and things like that. And that's why there's the cap on the debt ratio because lenders want to make sure that there is a little bit money left over each month that the client can budget accordingly to pay for their other household expenses and things like that. So again, when we add up the debt, so the housing payments and then anything else with the minimum payments reporting to the credit bureaus, and again, there could be some things that aren't on the credit report that we do have to count towards debt ratio, things like child support, alimony. If you own another property, maybe it's free and clear, but you're on title, you're still responsible for the property taxes and insurance that you're paying on any other properties that you may not have a mortgage on. So we do still have to count those things. But again, you add up the total debts and then divide it by that total gross income. Okay, so if you're a salary, it's very easy to count what your salary is per month. But for other clients that are either on commission, if they're self-employed, variable income, again, we can count before taxes are paid. But there is a certain way that lenders do have to look at income to know exactly how much income that we can use to count towards that debt to income ratio. So it has to be documented income that we can prove to an underwriter when we're going through that process. So hopefully that's helpful for everybody to at least kind of get an idea of, when the lender is reviewing an application, what types of things are considered. And the debt ratio, again, is important because depending on which program you're using, it'll give you a different debt ratio maybe that you can go up to. It'll let you know how much of a home that you're going to be approved for. And, it's definitely interesting and things that people should, know about when they're looking to apply for a mortgage. I think this can be very helpful. So thanks again for stopping by. If you have any questions, as always, feel free to reach out to me here anytime, and I'll talk with you all really soon on the next video. Hope you have a great day.